are we in a world where we have to look at this as a higher level overall? Or if you look at the curve, does that wind up coming down at some point, Ira? How sustainable is this rise?
Yeah, so the forwards right now are actually pricing for Libor to come down by year end. It's still more elevated than it was a month or two ago, but still significantly lower compared to the overnight index swap rate, the Fed funds rate, by year end. So the market at least thinks that this is a short-term phenomenon. The risk, of course, is that it's not, and that can have pretty dramatic knock-on effects if it were to be sustained for a long period of time.
And Scott Miner, that's the question. What is the risk that it's not just a technical, that it's not just a one-off, that actually is revealing something that's more troubling about the system?
Well, I think it really is telling us that the U.S. Treasury is crowding out. With all the issuance and Treasury bills going on, and the money fund reform that we went through, it's just costing more money for people to borrow short term. That's it. And so, I think this spread between U.S. Treasury bills and Libor is probably going to be more sustained, and that, within 3 months, I think it's likely that today we're sitting here with a Libor rate at like 2.25. That would probably move up to more like 2.5. And I think the market's pricing, forward markets are notorious for mispricing things. So I really don't think we can look at the forward rate and expect that we're actually going to follow that path.
So, Ira, is that the way you see it?
Well, so absolutely. I would note that 3-month Treasury bills have actually risen quite a lot to compared to OIS as well. So 3-month Treasury bills used to trade at minus 10 basis points to OIS, and now they're trading at plus 10 basis points to OIS. So at least a portion of this move in Libor can probably be attributed just to the fact that there's a lot of Treasury bills, and those are moving a lot higher. I would note that when you think about this from a credit quality perspective, look at what's happening to bank credit default swaps. So what's happening to CDS? CDS is high relative to the recent past, but it's only been about 5 basis points, not signaling any kind of serious financial stress, even though it's costing a little bit more to hedge the credit risk of banks.
That's a great point, Ira. But Scott, nevertheless, there could be some reverberation throughout other markets. For example, I know Evercore came out and said at some point 3-month T-bills are going to be much more appealing than equities, for example, because you're getting that yield pop. Do you see that rotation at all?
I don't see that yet, but the thing that I am getting concerned about is this increase in Libor, the repricing of bank loans, and if my view of the world is right, that a year from now we're going to have rates 1% or 100 basis points higher than we are today, then we're going to have Libor at somewhere around 3.5%. Or 3.25%. I mean, at those kinds of interest rates, believe it or not, that begins to soak up a lot of the free cash flow in corporate America, especially for below investment grade companies. And the credit concerns, I agree with Ira, the credit concerns aren't here today. But there are a lot of companies that are zombie companies that have survived from the last cycle. And we just saw iHeart, any number of companies. So as these companies have their debt being repriced by the market and rates going up, it's going to be harder and harder to stay alive.